Look at these homes. Millions of families living inside them, children growing up, dinners being shared, memories being made. But behind nearly every one of these homes, there is a contract, a debt, a promise that can last 30 years. It's called a mortgage, and the story behind it is far older and far more dramatic than most people realize. To understand mortgages, we have to travel back more than 4,000 years to the fertile lands of ancient Mesopotamia. Long before modern banks existed, people still needed loans. A farmer might need money for seeds or livestock, so he would offer something valuable as a promise: his land. If the debt was repaid, the land remained his, but if he failed, the lender took it. The basic idea behind the modern mortgage had already been born. Centuries later, Europe developed its own version of land-backed loans. And this is where the word mortgage first appeared. It comes from Old French, mort, meaning dead, gage, meaning pledge. In other words, a dead pledge. The debt dies when it is repaid. When mortgages arrived in early America, they were incredibly dangerous. Most loans lasted only 5 years, and at the end of those 5 years, the borrower had to repay the entire balance. He pauses. Imagine borrowing hundreds of thousands of dollars today and being told you must repay it all in just a few years. For many families, that was impossible. And when they failed, they lost their homes. In the 1930s, everything changed. The Great Depression swept across the United States. Jobs disappeared, banks failed, and millions of homeowners could no longer repay their mortgages. He speaks slowly. Foreclosures spread across the country. Entire neighborhoods were lost. The mortgage system itself was collapsing. In response to the crisis, the U.S. government did something revolutionary. It redesigned the entire mortgage system. In 1934, the Federal Housing Administration was created. Its mission was simple: make home ownership safer. This is when the modern mortgage was born. Longer loans, lower down payments, and fixed interest rates. The most powerful innovation of all was the 30-year mortgage. Instead of paying off a home in just a few years, families could spread payments across 3 decades. Suddenly, millions of people who never imagined owning property could finally buy homes. And entire suburban cities were born. But history has also shown the danger of mortgages. In the early 2000s, lending standards loosened. Banks approved loans for people who could barely afford them. Housing prices soared. Investors speculated. And eventually, the bubble burst. The financial crisis of 2008 shook the entire global economy, and millions of families once again lost their homes. Today, mortgages are one of the largest financial systems in the world. Trillions of dollars move through housing markets every year. Yet the basic idea remains the same as it was thousands of years ago. A loan, backed by land, a promise between borrower and lender. The mortgage has shaped cities, it has built communities, and it has helped millions achieve the dream of home ownership. But like all powerful financial tools, it must be used carefully, because a mortgage can build your future, or, if misunderstood, it can control it. If you enjoy learning about money, history, and the forces that shape our financial world, follow this page for more finance updates and insights.